This is Accessing the Pipeline, a podcast for Black professionals in private equity and finance brought to you by McGuireWoods. Join host Rubin Pusha III as he welcomes special guests offering insights into accessing capital, developing and expanding relationships, opportunities, and driving growth for Black-owned businesses. Tune in to access the possibilities.
Welcome to Access in the Pipeline. My name is Rubin Pusha III. I'm a partner at McGuireWoods and your host. Please join me in welcoming today's guest, Omar Simmons, who's the president of Exaltare Capital Management. Omar, thank you so much for being here today.
Thanks for having me, Rubin.
Well, look, we won't waste any time. We'll jump right in. I think the best way to kick this thing off is let's start by talking about your background, both as a private equity and investment professional, as well as an entrepreneur, and how that led you to found Exaltare Capital.
Sure. So my personal background, I grew up in inner city Boston, and in a type of neighborhood where everyone had a hustle and people had side hustles, and so it was a very entrepreneurial environment where you had to kind of go get what you wanted, and it didn't necessarily fit within kind of traditional boundaries. And so when I went off to college, I was very interested in business. Spent some time in management consulting. Spent most of my career in private equity at larger firms from kind of 95 to 2011, 2012. And ultimately, I wanted to kind of marry my entrepreneurial interest with a lot of the things that I learned in private equity. And so I went out, bought a business, and ended up running that business as a CEO and as basically the private equity sponsor for some time. And then that was the beginning of Exaltare Capital Management. We have since went on and sold that company and made some investments in several others. But that's basically how the journey started.
Awesome. And I think one of the things that we want to highlight for those listening in is it is a unique position to be able to look at deals and be in this space, having one worked in traditional private equity, two also having been an entrepreneur of sorts and been an operator. I think that there are quite a few people who just don't have all those perspectives when they're playing in the space, and we'll talk a little bit more about how that plays into your investment thesis and how you do things a little bit later. Before we jump into sort of the meat of the questions, it'd be good, I think, to give the audience an overview of Exaltare Capital. What areas of focus or industries do you focus on? What's your investment strategy? What's the check size that you like, et cetera?
Yeah, so Exaltare Capital, we started in 2012. We focus exclusively on franchising and multi-unit businesses, basically specialty retail type of opportunities in the consumer sector. We like to be the first institutional investor in a company. So by definition, that tends to be lower middle market companies with maybe 2 to 20, $25 million of EBITDA. And we view ourselves as kind of catalytic capital, right? So we're going to bring more than just money to the table because we're trying to professionalize and scale these companies. We are value add / operating oriented. So we don't necessarily look for the broadest portfolio. We have a small number of companies at any one time, and we spend most of our time trying to grow those companies. In a more traditional private equity context, you do a number of deals, you have maybe broader diversification. For us, we maybe mitigate the lack of diversification risk with paying a lot more attention to each company. And we don't want to run the businesses, but we're in close partnership and try to be a value-added support to the management teams that actually run the business on a day-to-day basis.
Awesome. You talked just briefly about your expansive sort of PE investment background and also your background as an operator. What was happening in the marketplace, both or as well as with professionally and personally back in 2012 that said, you know what, I'm gonna walk away from a position in a committed capital environment to go more so to this independent sponsor model. where on a deal by deal basis you're looking for checks to get the deal done?
Yeah, it's a great question. I think most of my friends thought I was crazy. Like, why would you leave pretty cushy PE kind of context? I had raised my own fund with a group of partners before I joined Windjammer Capital, which was the last large PE firm I was a part of. So I had some entrepreneurial experience. And I think that was important because it maybe wasn't as daunting to me to kind of go out on my own and create my own shot. Ultimately, I think there were two things going on in the marketplace at that time. One, private equity was clearly becoming more institutionalized. The firm that I was with was great. Windjammer, they're great investors, but most of the deals we were bidding on were through broad auctions. The joke was kind of we're buying everything from Harris Williams, from another PE firm that already owned the company, and you felt a little bit like a stock picker as opposed to a company builder. And so that environment is really stimulating, but I did question to what extent is it sustainable to kind of recreate value. And so I was very interested in the lower middle market, where I'd spent some time. And there are aspects of the lower middle market, if you want to be the first institutional investor, where I wasn't sure the committed capital model was optimal, right? Because by definition, when we raise a small amount of money, you have to do a lot of deals. You have to have a same back office as you do for a larger fund, and you're not amortizing those costs over a large fund. And can you attract the same type of talent? And you're going to be diluting your efforts with a large number of companies that are smaller and more fragile. And I just wasn't sure that all made sense, given my interest and what I wanted to do. And so the thought was, well, let's test this and let's just go out and buy a company, right? Which isn't really any different than I've done my whole career. I had the deal flow, knew what I wanted to look at, understood how to underwrite, structure, partner with management teams, and create value. The only part that wasn't clear is would I be able to get financing in a timely manner? And I found that if you got good deals, you could get financing. I was fortunate that I had made enough money in my private equity career that I could kind of sustain myself during those dry periods, which I think is an important consideration. The part that I didn't fully appreciate was what my role was going to be post close. I wanted to be more than just a stock picker. I wanted to be clearly active in the company. I didn't have in my mind that I wanted to run the business. At the time, there wasn't anything really called independent sponsor. There was maybe some people that would call it fundless sponsor. We had done deals like that at Windjammer to support people. But there was this clear bifurcation between are you an operator, are you an investor, are you a deal sourcer? And they all had kind of slightly different connotations and economic models. I wasn't sure where I really fit in that spectrum. I talked to people that were more traditional, kind of what they would call search funds, where they're like, well, you have to be committed to run the business. And if so, we'll give you capital. And I was like, well, I don't know if I'm committed to run the business. It depends on the business, depends on the management team. And I don't know if that's what I'm after. I want to give the business what it needs, right? It's Paul Pierce used to say, right? They give the game what it needs. And so I didn't know exactly what I was stepping into. Ultimately, when we bought our first business, it did require a significant amount of management oversight. And ultimately, I did become the CEO. But I'd be lying if I said that was the initial plan.
Yeah, yeah. Um, I want to go back to some. I know we're not the focus of our conversation today is not sort of emerging managers, but I think that there's a theme that exists if you're either you're a GP, you're an emerging manager, you're raising your first fund, second fund, third fund, and being an independent sponsor, which is you've got to be willing to invest not only your time and energy but some of your own capital in order to make it successful. And so, I just wanted to highlight that point for our listeners and to give you an opportunity to talk about, what's that right mix of, equity, debt, your own capital. What should people expect if they're going to be, if they're going to be an independent sponsor, trying to grow a portfolio deal by deal in the ways in which you've done?
Yeah, look, I think it is a super important question, particularly important for people of African descent and people of color, right? Because we don't often have the rich uncle, as I call it, right? That's hanging around, been there, done that, maybe could give you some capital. For me, I thought of my entrepreneurial pursuits around two kind of dimensions. The first is, when do I know enough to be able to take that risk? And second, when and how to finance that risk, right? And the first entrepreneurial leap I made was after a couple of years of business school when I was at a firm called McCowan DeLue when I left. And we started, with mainly black and brown partners, we started a small private PE firm, $122 million called Reliant Equity Investors. There, I had the skill set and the energy to do it. I didn't have the capital, but my partners could help me. Some of them were older, and that was kind of the trade, right? They could help finance our period where we didn't have enough management fee to pay the bills. I still had to take a pretty significant pay cut to take that risk, but at least I could eat, right? And my wife worked at the time. 3 kids later, my wife's at home, kids are in private school. It was a completely different equation. My burn rate was very different. My lifestyle was very different. And so I had to have enough money in the bank to say, hey, I can do this without really changing their lifestyle. Not only was I not going to make any money, kind of had to support a small team. Uh, and I also didn't, it wasn't a traditional path. You didn't know exactly when you were going to close a deal and then how much money you were going to have to put in a deal. And so I think a lot of the capital providers are sensitive to, you may not have as much money in your first deal or whatever. For me, given my background and just given my orientation, we put real money in the first deal. And so when you add it all up, there's the opportunity cost of not making it. And then you had to put in more money. And then depending upon how you're going to source and process deals, you had to kind of support resources around you. And I think do that in a way where you aren't single threaded is wise. And so I do think that means there are certain windows of opportunity to take these entrepreneurial risks. And I encourage people, again, particularly people of color, to think long and hard about your personal balance sheet, about your family, about your husband or wife, and make sure everybody can absorb that risk because it can be extraordinarily stressful time.
I appreciate the transparency on that piece. I think as people, one of the things that's at sort of the core of this initiative is trying to encourage more people to get into space, encourage people to take, some of these risks, understanding that there is a likelihood of success on the other side of it. But you do have to, you have to be prepared for when will that success come? Is that success through portfolio optimization, or is that success through an exit, 3 years, 5 years, 7 years down the road? And if that's the case, that check may not come in the way that you anticipated it for a little bit of time. So you got to have something to sustain you in the middle. So appreciate that transparency there. In that same vein, you know, having to take a look at your personal balance sheet, thinking about what other things you have going on, I would imagine you're still maybe particular about, who you take capital from, when, where, and why. What are some of the table stakes when you're thinking about who's going to be a capital provider, be it debt, be it equity, whatever it is? I imagine you've got sort of a thesis around that. Would you mind sharing that with us?
Yeah, look again, it's extraordinarily important. I think when I was in more traditional committed funds, we still thought a lot about what's the nature of our debt partners, for example, right? Because no matter what the spreadsheet says, deals don't go straight up. There's usually ups and downs, and if you hit an air pocket, you want to know you have a good partner that's not going to freak out or pull the plug. That said, it's even more important to have a good partner when you're an independent sponsor. We've had deals where groups have flaked post LOI. You got busted deal risk. You got will the deal close because you had to introduce them to the seller. The seller's like, well, what happened to this other group? And so for me, there are a couple of really important considerations. One, does the deal fit the I don't know ethos of the partner that you're partnering with, right? Like no matter what type of investor you are, and even in most flexible groups, everyone has to have a strike zone. implicitly or explicitly. Type of size, type of risk they like to underwrite, type of people they like to work with. Because that's just how institutions and people are, right? They get comfortable in a certain space. And so I try to understand, does this really fit what they do, right? Where they're comfortable. Because if someone's a little bit on the outside corner and they're a little uncomfortable and they learn something in diligence or something happens post close, they may not react in a way that's healthy for the business or for the transaction. I think the second thing is, are they, high integrity people I can trust, right? Because the most important thing I'm going to be risking is my reputation and my time and my money. And so um, things happen. There's no way to predict every twist and turn in a deal or a life of a deal. Um, but if there's a kind of character alignment or integrity, you can talk about it, you can work through it as a trust level to say, even if you don't agree on everything, there's a way to work through it. And the last thing is, I don't know what the right word is, but maybe credibility, certainty of close, certainty of being a good partner post close. And the good thing now is because there are more transactions in the independent sponsor space, and because there are more capital providers that are consistently in the space, you can check each other out, right? Moreover, the smart groups know that their reputations follow them. And so if they care about their reputation, they'll do the right things more time than not, right? And I think that's what you want because you're in an incredibly vulnerable period as a sponsor if you get the wrong part. I've seen independent sponsors on the path of creating value, and they would say that their partner, just because they weren't aligned, and that misalignment ended up destroying value, right? One wants to exit, another one doesn't. One wants to fire the CEO, another one doesn't, right? And how do you create an alignment so that you're both looking at the same things and have the same framework to make decisions? You try to do your best to kind of make those decisions up front. I've been really, really fortunate that everyone we've partnered with has been great. And we've been through a lot of difficult situations and difficult conversations, but we feel like that's been extraordinarily fortunate for us.
What's that alignment look like beyond the capital providers when you're thinking about, potentially bringing in an investment banker or what law firms you align with? Because as you mentioned, with these independent sponsor deals, the certainty to close, I think is ratcheted down just a little bit from sort of traditional strategic M&A transactions. And so you got to be prepared for, how to deal with busted deal fees, including Q of E's and legal spend. What have been some ways that you've mitigated some of the risks that can happen if you've got a busted deal?
Yeah, so a couple of things. I think the first is I'm fortunate and I've worked in these firms. I think I know how they think, and I think I understand their constraints and what's important to them. And so I think that helps me maybe get to the heart of the matter a little quicker. The second is I just ask for alignment, right? So like we asked them to pick up some of the busted deal fees. Some firms are better able to do that than others. But we explain to people it's not just the money. It's I don't want you window shopping, right? And if anyone can say, yeah, I love this deal, it's under LOI, it looks great. It's like, no, if you walk, I want you to feel a similar amount of pain to me, and you still won't feel the same amount of pain because you're going to absorb it in some big institution. It's my personal balance sheet with a small team. And so that's one of the first places I try to get some alignment. The second is because my background's more in controlled buyouts, we kind of view it as it's our job to run the whole deal. And so we will pick our service providers for the most part. Now, it doesn't mean we're not open minded if someone has a specific thing, but we can't, unless they're going to commit the capital up front, they can't dictate all the service providers. And so we have had the good fortune of working with some different service providers at different stages of the deal. And what we try to do is make sure there's alignment with the capital partner, with who they are, their rates and their style, their quality, their reputation, and those things. And that's part of signing kind of exclusive term sheet, right? We had one group at one point was like, yeah, QVs are fine, but every deal we do has to have an audit. We're like, okay, I hear you. Audits cost a lot of money. They take a lot of time. We ended up saying, we don't love them, but if we do it, you're going to pay for it. And then we said, well, you can't just isolate that one, so you'll pay for part of it. But we ended up working it out such that, again, there was some shared risk on that. And they brought in a very particular group that they wanted to have in for every one of their audits. And so I think we try to mitigate that. And we try to be upfront with, if we were doing a deal together, hopefully we would develop a long-term relationship, a partnership, so that, things may happen in a particular deal. But if we're going to be in this business, there'll be other opportunities to create fees for both sides. And maybe some of that will roll over or something. And so I think for us, the idea of kind of long-term partnership is one way to mitigate that, so that everyone that we deal with understands that, we're going to make sure you're not left holding the bag, but we might need some flexibility here so we can all share a little bit of risk.
I think as a firm, that's our approach, right? Is we're committed to the independent sponsor space and recognize that, when you're a partner and you're developing a long-term partnership with someone, one of the things you don't want to do is, I don't want you to feel like you got to do this deal because you've got, whatever number of legal fees hanging over your head. And so, beyond whatever discussions need to happen with the potential buyer or with you as a buyer, seller, and in some of the other fees you incurred, and we're going to have a conversation about, well, maybe we could park some fees here, and if we, you get ready to do another deal down the road, or even a series of deals, that we can find some ways to some creative ways to kind of spread the love across the entire the entirety of the relationship. And I think that's something that, if you're going to be a service provider in a space, you really got to be really got to be uniquely aware of, and be intentional about making sure your client knows that heading into the deal. So all good stuff. Now, the sort of the meat and potatoes of what I wanted to talk to about today is you recently had an exit, and wanted to sort of talk through the portfolio company exit. And could you just, to start us off, give us a little bit of background on that transaction, and how it came about?
Yeah, so our first deal was a Planet Fitness franchise. Planet Fitness is the market leading health club fitness provider in the country. At the time, we did this deal in 2012. You know, not many people knew about Planet Fitness. I had in my past invested successfully in a business called 24-Hour Fitness when I was at McCown DeLue. Made about 11 times their money. So I knew a little bit of enough to be dangerous. And this particular deal really fit our strike zone. It was about 5.5 EBITDA. It was fundamentally sound. Um, it needed some help managerially. It was undermanaged. It was pretty steady despite being undermanaged. It couldn't grow, or management hadn't figured out a way to grow it, and they were willing to roll over 15% the sellers were of their into the new co. And we basically, could afford it, right? Because it was a little bit of it was a hairy, complex transaction. Uh, so we closed the deal. I put in some money. We brought in a group called Brightwood Capital, did the debt and the equity, another African American owned group. They were really more of a debt oriented SBIC. And I was the executive chairman at close, which basically meant, you know, I was the neck that could be strangled, right? I was holding myself with, I'm accountable because it didn't have a traditional CEO. I pretty quickly realized it needed more than an executive chairman. It needed a CEO. So I became the CEO. One of my colleagues, who's now our director, basically became the CFO. And some of my kind of operating affiliates, helped out. They were like on the COO. And we kind of built in the team. We ran the business for right? So phase one of Planet Fitness was we were clearly the sponsor, right? We had an investment thesis, a buy and build strategy, and we had to kind of fix the business, grow the business, and we grew the number of units from like 15 to 50 and EBITDA from like 5 to 20 pretty quickly, a couple years. Then we started bringing in a more traditional management team. It was better than we were. And at that point, Brightwood was getting ready to raise another fund. And they were like, hey, this has been a good deal for us. Kind of book this so we can sell, we can raise more money. We said, well, we just got this new management team, we got the new growth initiatives. Why don't we just buy you out? So we raised a small kind of institutional fund that was more of a special purpose vehicle to hold that Planet Fitness asset, maybe do one other deal. And they stayed in the debt and took a little bit of the equity, but they earned a really nice return. And we were kind of, doing more or less the same thing we did, but as a more traditional sponsor with a little bit more equity because we never had patient equity capital. We were disproportionately dependent on debt. That allowed us to kind of grow a little more aggressively. And so we went from, I don't know, about 50, 60 units to over 100. Then we got to 2012, and candidly, we were thinking about selling. We were getting ready to run a process, and fitness clubs in 2020, got hit by COVID, right? And so things changed, right? From interviewing bankers to spending all my time with landlords and lenders and governors and mayors trying to survive, right? I mean, it was all hands on deck. We had to lay off 1,500 employees. And so it was a really challenging time. But we kind of had those two chapters, right? Chapter one was a little bit more operationally and sponsor oriented. Chapter two was a little less operational, but still pretty hands on, more traditional role. We had a good CEO, good management team. And then we had this kind of extraordinary event during COVID. Make a really long story short, we got through that period. I think we got through it stronger, candidly, and actually kind of started shifting our thinking. We realized we're going to survive and we may even thrive. 20% of our competitors are dying or gone. 25% are going to go. Maybe there's some pricing opportunities here from an acquisition perspective. There are probably sites and other things that are available that would ordinarily be available. We worked out something with our lenders, which happened to be Brightwood and some other groups that had joined in. But they at least had some history. We had some history and credibility with them. It's kind of said, look, we're going to put our foot on the pedal here, and let's both think offensively and not just defensively. And this was kind of really early 2021. The vaccine had just come out. And so we built the pipeline, and we were getting ready to go play offense. And more luck than skill, a couple of groups started knocking on our doors saying, would you transact? And initially, I was like, I'm not even I don't have time to play these games. You're not going to buy me for 50 cents on the dollar. We're not desperate. We have a plan. We have a capital structure to allow us to endure. Some groups were like, no, we're not trying to buy you on the cheap. But in my mind, our EBITDA was half as much as what it normally is because we had all these closures and all this mess in there. And I couldn't take a management team that was really focused on creating value that had just come through and hadn't even finished getting through this really difficult, tumultuous period and distract them with a transaction and even make them think that it was possible to get out early because I kind of been very consistent saying it's going to take 2 or 3 years for us to build back up to where we were. Ultimately, we had a number of groups that were kind of interested. And then I was bidding on some other deals in similar situations. And people were looking through the pandemic affected EBITDA. They're making adjustments. They kind of could understand, well, if we weren't closed, this is what you would make. Those deals were getting financed. I was thinking, they were smaller than our deal. So I was like, those deals are getting financed. Maybe my deal. My deal get financed. Maybe it is talking. So we talked up 3 of them and didn't hire them. We basically became the investment banker. We're pretty candid. Like, this is what's going to take for us to engage. At this price, we'll talk. And long story short, one group, a firm, ended up buying controlling interest. We did, myself personally, and some of the other my partners that I work with did roll over some of our personal money. But The fund got out whole. He did very well despite COVID. And so from beginning to end, I think we're an initial investor, 12 times. But each segment along the way also made some it was great for our management, great for the people that had been a part of it. But it wasn't straight up, just a lot of ups and downs.
So going through that process, and having having a banker lead it, I know that and no disrespect to all the bankers out in the industry. I mean, those guys drive really, really, really hard, and they're looking to get a deal done for obvious reasons. How are you able to sort of manage the process and get to the right buyer from your seat? Because I would imagine that the right buyer was something beyond just check size, given that you had just brought on a management team and you were thinking about potentially rolling over some of your own money into the deal. So viability post close is a pretty important thing to you, at least in part at this point. And so just curious, how you sort of drove that process and what the right buyer in your mind looked like.
Yeah, so the three groups we engaged in all kind of knocked on our door. But we had been around the M&A in the space long enough that we knew what a right buyer looked like. So you could recognize it when you see it. One was a family office, one was kind of a strategic, one was a private equity. And all of them had a thesis as to why it made sense for them. Part of what we were trying to assess is, did it really make sense for them? Could they hit the price that made sense? And were they going to deliver the certainty of close that made it worth us taking the risk to go down this road, right? Because in normal times, maybe you can play these games. We were still in very fragile times, right? Like, so wasting a lot of time and money and energy wasn't something we were interested in. Our best mitigate, candidly, if we had built a business that we were prepared to hold out, and rather than hire, we could credibly tell the group, look, if we engage, we know this is a hairy story. We're going to tell you what we were willing to engage at, but you're going to have time and have an exclusive look to do your work. And so we customized the process that would kind of mitigate the risk and share the risk around these parties. And so I think that in some ways increased the probability of success as opposed to more traditional auction where we just hire a bunch of people, because I've been on both sides of that. If I'm making an auction, I'm like, well, there's all this hair and I'm gonna spend all this time and I don't know what the price is. I don't even know if this is gonna be a good use of time. It's a low return on, I'm not gonna spend time on it. As opposed to, you really like this space. We're gonna be very transparent about what we have and what we're willing to do. And if you're willing to be in that neighborhood, then we can talk. You got a real legitimate shot, 1 in 3 or whatever it is, to take this off the table. And so that's what we did. To your point about was it more than just the traditional considerations? I mean, for us, we didn't have to roll over if we sold with one of these groups, but I think we kind of wanted to, and we were open to it, right? And for some people, that's a signal, right? Value, but we basically felt like this is a business that had enduring value, and so being able to signal like, yeah, we're open to rollover, I think was important to both sides. And the partnership thing becomes more important. I also was effectively a founder, right? So me and my team, we felt like we built this team. We literally handpicked every management team member, and they had invested a lot of their time, was really depending on this for their own wealth creation. They hadn't been able to take money out much and had a wealth event. So making sure they were going to be in good hands was a consideration, and making sure we were partnering with somebody that we felt could take the business to another chapter, another level. And we felt like we really found that with this group, Tower Brook. They were honest, trustworthy. They looked like they'd be really good partners. They were smart, and we thought they would be value added. And I think I'm still on the board of that business. They've proven to all those things.
I think about some of the things you just said about you know having a business that you spend a great deal of time getting to a really good spot. Then you've got the pandemic, which for as you mentioned, for the for sort of wellness business, where you can't it's harder to come up with ways to make money virtually when really you got to have people in the building using the equipment, taking advantage of the ancillary services you provide. And so now you're getting ready to exit this business and sell it, and you're in a really in a different position than a lot of people who are at that exit inflection point where their balance sheet, their financials are as robust as they've ever been. You've got yours where, look, we were here, but now we're here, and here's the reason. And obviously, people were willing to get creative and looking through that. But now I think we've sort of through that we found ourselves in really good times in the deal space. And now as we peel through the first quarter of 2023, we're almost back at another sort of another inflection point where debt costs a lot of money. We've got banks on the brink of failure. Folks are a little bit more skittish to do deals. Are there any sort of lessons learned from that experience that you think are going to be applicable as we continue to press through what many are predicting to be a little bit of a difficult time in 2023?
Yeah, I spent a lot of time on this with my team and my portfolio company CEOs. I'm a little older, man. I've been in the game a while. I've seen a lot of cycles, right? I mean, I got in this business in 1995, so I remember, 2001, 2008, COVID. A lot of people haven't invested through, particularly at a senior level, a lot of cycles. Things can change, things will change. And I do think we're in a particularly volatile or risky period right now. And I think the world recognizes that. To your point, it creates a gap, right? There's higher risk. Buyers are going to say, I get compensated for that risk. And so I need a lower price because things may not go good. Sellers are like, what you talking about? My boy last year just sold it, 9 times. Like, what? Why you think it's still 9 times? And you're like, well, all the reasons you outlined, debt's higher, risk premium's higher. But they're like, whatever, man. Like, I've been working on this my whole life. Why would I take a discount, right? And so it creates a disconnect to get things done. I think for us, again, we're very focused on, creating value, making the pie bigger for all the people involved, all the parties, all the stakeholders. And so we tend not to be in super aggressive auctions, but we'll participate in them certainly when we have an angle and it fits our strategy. But we try to be in situations where 1 + 1 = more than 2, right? That means that if we're buying, a business, hopefully they view us as value add. If they view us as value add, we almost require that there's some role in every deal, some sort of skin in the game. Maybe it's a seller note or something. But that means that that second bite is valuable, right? That and so that's a currency that you can play with to bridge valuation gaps, either explicitly through ratchets or implicitly through, if we add some value, you'll get dollars and you'll get some shares, and that share should be worth a lot of money in the future that you leave to your kids or keep yourself. Second thing is we have used earnouts. The last 2 deals will have earnouts. Um, we don't love earnouts, but we've been fortunate that we've been able to kind of structure earnouts to create good alignment, right? So when these unexpected things happen, sometimes it was because of COVID, right? Sometimes it was because of things you couldn't predict. But a lot of times what we found is like, look, we both can acknowledge this. You may not know how it's going to turn out. You may not know who's going to pay for it. But if I can give you enough cash that you can feel comfortable, we're going to have to share this risk here going forward, right? And since you think there's no risk, you shouldn't be scared to take a little bit of it yourself. and um, if they're not willing to do that, then maybe that's not the right deal, right? And so the last thing I would say is, can can you focus in areas where, for us, again, it's a little bit of a more limited set of kind of competitors, right? So are you focusing in areas where it's more of a one-on-one type of situation or one-on-two than it is, 1,000 people bidding on a deal? I think that's just the dynamics because then you can really have real conversations as opposed to, all right, management meeting's over, you have to go home and tell me your best bid, right? Because we don't know enough and they don't know enough. And so I think the ability to bridge these valuation gaps are partly relational and partly, again, I go back to the word partnership, right? Can you kind of find a way to get something done? If the answer is no, that's okay, right? But at least you can spend the time to explore, can it work? And you can't get those customized solutions in really limited, rigid processes.
Yeah, no, agree with with all those points. Appreciate you sharing a little bit about that transaction, and I want to pivot one more time here and kind of talk a little bit about sort of the Black professional private equity and finance ecosystem, but also that sub ecosystem of independent sponsors. I think, we at McGuire Woods, I mean, we're as a firm particularly focused on the independent sponsor space. I don't know another firm that does more deals in that space than we do. And shameless plug, we have a huge independent sponsor conference in Dallas every year that we've outgrown, our host hotel and are moving it to a new space, and we'll probably have 1,300 people, at our next one. Will be a mix of, capital providers and independent sponsors and lenders and so forth. So, but kind of drilling down on the Black folks in that space, I can only imagine that you've experienced some things, some challenges that are unique to the Black experience in the independent sponsor space. And obviously we don't want to name names or make anybody look bad, but interested in hearing, some of the themes that are developed that you've sort of noticed over your time in the space, and what are some of the mitigation strategies that you've learned, developed, and deployed over the course of your career to overcome sort of that gap between, people say they want to do business equally, fairly across the spectrum of people that play in the space, but then the system doesn't necessarily support that mantra that, and I know people mean it, but at the same time, the system's not necessarily set up for folks that look like you and I to have some of the same advantages that our counterparts do. And so just curious if you drop a couple nuggets on us on what you've seen and how you've overcome those things.
Yeah, no, that's a great question. I appreciate having a venue to even talk about it, right? Because it's not always easy to address. Look, I got in the game in like 95. When I was in private equity, I could count the number of Black people in the game in like one hand. It was just really small. In fact, I used to look for proxies like, do they have women? Do they have Jewish people? Maybe Catholic people, right? Like you just look for any semblance of diversity in the in the private equity um, to say, okay, there's some open mindedness here. And I don't know. It was always interesting and subtle, right? I mean, I remember my first, well, like I said, I won't name any names, and I ended up loving this guy. He was one of my best bosses ever. But I remember in the middle of the interview, he basically said straight up, like, we never hired any Black person before. Like, I was like, well, okay, I never worked any place that, that did, right? Like, so what's next, right? Like, but I appreciate what he probably, probably was against HR's policy or something, but like, I really appreciated his candor and being direct, right? Because I think what he's basically saying is, we may make mistakes. Can you handle that? And I was basically like, look, I'm good. Like, I don't expect perfection here. I just want an opportunity. I think things have gotten a lot better as far as representation. I think it's still really hard to be a player, you know, a senior partner at these firms. But I do think the talent is in the pipeline, and we're very talented folk. And so it will happen just because of hopefully competitive pressures. But I think for me, the three biggest barriers have been, for lack of a better word, cultural capital, right? Like, so some of this can be just, I'm always trying to be careful. Like, I can think of it, one of my gigs, one of my PE firms, I was pretty senior. I remember coming in, I thought I was going to be responsible for a particular territory. And then some other guy that had been there was like, yeah, you don't really want that territory. you want this other territory. So we're going to switch. I was kind of like, why do you want it if it's so great, right? He's like, you don't mind, do you? I'm like 2 days in the job, like, I have no logical way to say one territory is better or not. And even if I did, I'm not going to come off like a team player. So I was kind of in a bind, right? Like, I can't demand. I was like, I don't know if I want this territory. It made sense for me since I lived in this particular area to run that territory. So ends up that, I think the senior guy just didn't want any trouble. He was like, yeah, you don't care, right? I was like, I kind of do care, but do whatever you want to do, right? Like, I'm the team players. He's like, all right, you'll just switch. Ended up, it did put me at a career disadvantage because that other territory was just more fruitful and lucrative, which was kind of predictable, right? Was that because I was black? No, I doubt it, right? But it certainly is possible, right? But at the cultural capital of, me not having a lot of people to kind of talk to about how to deal with this, and I knew I was the only black or brown person around that context. Like it, it can make me double clutch a little bit. It can make dealing with all these kind of subtle political structural issues a little more difficult, particularly when I talk about the second barrier, which is basically to be in a partnership model means that you not only have to be good at what you do, but you have to get along. You have to connect. You got to feel like kin. And I remember my first few jobs in PE, like I didn't fox hunt, I didn't golf, I didn't want to kick it with them on the weekends, right? Like I was doing a completely different set of stuff. We were going to complete after work, we were going to completely different areas. So I didn't have that lubricant, right? To be like, "Oh, yeah," right? Like, which counteracts a lot of things, right? Now, maybe I moved a little bit, but I would argue those firms have to move a little bit, right? Because back then, the partnership groups, and they're getting a little better, but I'll tell you, it was like 99% homogeneous, right? They all went to a good undergrad school, maybe top 10, right? They all did some investment banking, usually an M&A from, a handful of bulge bracket firms. They all went to HBS or Stanford, and it expanded a little bit from the top two to maybe the top five. Then they were in PE, and they're all white men, and they all lived in particular zones, right? Extraordinarily homogeneous. Is it a little better? Yeah, but that's still the weight of it, right? And so that means it's a certain lived experience. There's a certain lens through which they look at the world. There's a certain lifestyle. And so the things that I was dealing with for fun or for challenges, just different, right? And so that means it was harder to connect at that deeper level, which is really important if you're saying you're going to be my partner, right? Not just an employee, but a partner. I think the third thing and the last maybe thing that's been a little bit of a challenge is being able to bring all of myself to work. Right? Some of this was my own evolution, right? How do I do that? How much of that do I do? What's appropriate? Want to scare them off, right? Again, it's easy for me to say now, but like I was like, I don't care. Like I had to get to a point where like I had to learn to be my best self, right? And if it worked, great. If it didn't, because it's going to be hard in a really competitive business, competitive industry, to win playing someone else's game. And so, at our firm, and I wouldn't even say it's conscious, we work really hard to get a diverse set of people. Super talented people that have high integrity, really hardworking, they're smarter than me. And I think that allows us to make better decisions and it allows us to be more tolerant and see different things. And I don't know if we have to work that consciously at it, but it just comes from an underlying philosophy of bring all of yourself into the business, right? Because that's how you'll be special. That's how you'll be distinct. And that's how we'll get the best thinking. Again, we have, I'm black, we have people from, different countries and different people of color. And I think, we want to do better in that regard. And we try to encourage our management teams to do better in that regard. We really are proactive about it. It's not always easy. But I think it starts with that sensitivity around do you really want to see all of stuff? Or do you want to see them as a means to an end or a small, limited lens of who they are. And I think you're underestimating the power of, the talent that different perspectives can
Yeah, yeah, and appreciate the candor there, and I think there are a lot of parallels between private equity and big law. I mean, I don't remember the numbers exactly, but somewhere in that, and I'm probably being generous, that 2 to 5% range is what black lawyers make up big law, and the number gets smaller as we parse out for gender at the partnership level. And so it's a rarity to look across the aisle and and see someone that looks like you sitting in a partner seat leading deals, or being a thought leader in this space. And so and it's not that I don't think that any of us want a homogenous environment, but we want one where, again, like you said, you can bring your whole self to the table, and you can use that to harness our differences and create value across the spectrum of diversity in the workplace and in this particular industry. And yeah, we're getting better on both sides, both legal and PE. And I think this initiative and having folks like you on this podcast is going to be a catalyst for that type of change. A couple more questions in this space, and then we'll close out. But in that same vein, you talk about being able to bring your entire self to the workplace, and as you were looking for capital provider sourcing deals, leading teams. What are some of the misconceptions that folks have about Black independent sponsors as they're at marketplace, either looking to buy or sell something?
bring. Yeah, it's a great question. I mean, so much of what we do is around credibility, right? Because we quickly got to assess if this is a good use of time, money, energy, etc. And being an independent sponsor, in general, you lose credibility, right? If I was working at Windjammer or KKR or Summit Partners, your card gives you a degree of credibility. Your institutional capital gives you certain credibility. And so by not having and by being a person of color, particularly being a Black person, right? Because we have historically been at the lowest end of the socioeconomic thing. I mean, there's no question about kind of wealth gap and how persistent has been. And we're not the group that people think of as, smart. They may think of as athletic or whatever, but whatever bias they have, it's not like, oh, let me let this dude run my money. That's not the first thing that comes to mind. And so I'm sure it's a little bit of a disadvantage because we all have unconscious bias. And to ignore that would be, foolish. I think there are ways to mitigate that by just being conscious that people have bias and you have to kind of establish credibility, right? However you can, because no one would become an independent sponsor. Or I won't say no one. In general, because of the risk that you have to absorb, you gotta be pretty confident, pretty crazy, or some combination thereof, right? So being able to kind of communicate to the world why you're confident, crazy, and because you're betting on yourself, right? The thing I like most about it is why I think it's inherently a more entrepreneurial pursuit than being in a more traditional fund is there's perfect alignment, right? Like you don't make money unless your investors make money, unless your management teams make money. There is no leakage, right? There's no like you can be in a big fund and maybe this deal doesn't work, or maybe the management fees cover you or whatever. That just doesn't work here, right? And so there's a reason you're doing it. And if you're good and you're confident and you're competent, you just got to kind of get that energy out into the world so it becomes contagious. And think about how best to maybe frame it. But there's got to be some reason you and your loved ones think that this is a good use of your time.
Yeah, no, I appreciate that. What are some things that we can do to encourage more folks like you to look at this space as a viable option? And it's not to say we just have tons of people in more of the traditional committed capital vintage fund type of space, but at the same time, and we're trying to spread the talent across the continuum. How do we best do that? What are some things that you've done that encourage others to look at the space, or even providing hey man, I can't spend all the money. Here's a list of capital providers that might work for you. What are some of those things at the top of your list?
Look, so there's some things at a personal level, again, wealth creation, particularly around people of color and Black folk in particular, is really important to me and my family. So my wife and I are kind of starting or going to support investing in Black Rubin, kind of a nonprofit initiative that's going to try to create uh, more entrepreneurs of color to own franchises. Right? So we've been in the franchise business for a long time. We see a lot of people work and consume uh, food and things like that at franchises. We're saying, you have the ability to own and run these things. Part of it's a mindset shift. I think similarly in private equity, I think more of us are going into private equity, and that's great. And more of us are in the private equity ecosystem, which is great. I think more of us need to think about how to own the means of production, not just work for people, right? It's a completely different mindset, and it has no downside. If you think about how to own something, some of the pitfalls we talked about when you're working for someone, you're just not as afraid. You'll be your best self because you're like, if they don't treat me right, I have an independent skill set that is portable, right? I work for whatever, Rubin Inc., and I can go out and do this myself or take it to some other firm or whatever. I think it makes you a much better professional. I think third is, opening up, you know, going to the business schools and podcasts like this are extraordinary. But letting people know there's so much more than the traditional path, right? So for me, the traditional path was never quite as attractive. That's why I kind of jumped off. It's like, well, let me start my own fund. And then it was like, well, let me jump off, go back to a great traditional fund, but use that as maybe a learning laboratory to then go out and buy my own company or do other deals. And there's so many different ways to kind of play this private equity thing. But I do think the idea of controlling your own destiny is more rewarding than people might appreciate. And I think a lot of us can get, I don't know, subdued or get too used to the trappings of certainty, right? I got a nice check, I got a nice life, I got a nice car. And I suspect when you look back, early in your career, that wasn't the reason you got in the game, right? You wanted to create something, you wanted to contribute, you wanted to have an impact, not be a cog in a wheel. And the last thing, candidly, it can be just way more lucrative and way more fun and way more give you an opportunity to have a canvas to paint on, right? To leave your fingerprints, to leave a legacy, because it's really, really rewarding to feel unconstrained and empowered, right? That like you can choose how to spend your time and how to design your life and your professional career. It's harder, at least at certain points, been early on. But from my experience, it's been way more rewarding trying to do the things that you think other people will value so you can be rewarded by them, get promoted by, as opposed to you doing what creates value, you doing what creates wealth, you doing what makes a lasting impact on the communities you're trying to serve or people you're trying to work for. It's a completely different mindset. And I think more of us need to recognize how talented and gifted we are, and we're all blessed. Don't be afraid to use it. Take a shot. Worst thing that happens, don't work out, you go work back for the man. And then you go back out there and do it again, right? So
Yeah, yeah.
I think there's no downside, right? We can get this done.
Yeah, yeah. Great advice. We're gonna wrap up here before usually at the end of these, I try to do something a little bit fun, that'll allow our listeners to get to know you a little bit better, but also give them a couple of things in addition to, sort of the private equity substance that they got from our earlier conversation, but some things that they can do to enrich themselves as professionals. And so I just got, three quick questions, rapid fire. Recommend one book that's been transformational for your career.
The Bible, same thing, self-explanatory. Read it.
Awesome. Awesome, awesome. And then and I think maybe we've already kind of gotten that a little bit from you, but single best piece of advice you've received from a mentor, personally or professionally.
I would say, uh, I'm paraphrasing, but be the best you that you can be, right? Like be authentic and recognize you're who you are. Be the best that you are, as opposed to just modeling after other people.
Awesome. Ladies and gentlemen, Omar Simmons, Exaltare Capital Management. Thank you again for sacrificing your time and sharing your wisdom and experience with us. We really appreciate you for being willing to be on Accessing the Pipeline. Thank you.
Thank you for joining us on this episode of Accessing the Pipeline. To learn more about today's discussion, please email host Rubin Pusha III at rpusha@mcguirewoods.com. We look forward to hearing from you. This series was recorded and is being made available by McGuireWoods for informational purposes only. By accessing this series, you acknowledge that McGuireWoods makes no warranty, guarantee, or representation as to the accuracy or sufficiency of the information featured in this installment. The views, information, or opinions expressed are solely those of the individuals involved and do not necessarily reflect those of McGuireWoods. This series should not be used as a substitute for competent legal advice from a licensed professional attorney in your state and should not be construed as an offer to make or consider any investment or course of action.